Hi guys, welcome to accounting. Today we're going to be talking about inventory methods. What is inventory? Well, inventory is the number of items that a business has in stock, and a business has to make sure it has sufficient inventory in order to serve its customers. So how do you determine inventory? Well, basically inventory is the previous inventory plus receipts, which would be the purchases, minus the issues. And the issues are the sales that a business has made. Issues are outgoing items, and they're often tracked through a Upc code as items are used or sold. Here's an example of a Upc code. Usually it's a unique 12-digit code that identifies each item in inventory, and each item has its own specific Upc code. Not all businesses use this, but it is quite common in most businesses. Also, a stock reorder point. The inventory record also indicates a stock reorder point. The stock reorder point is the minimum level of inventory to meet customer demand. When inventory reaches the stock reorder point, a new order must be placed. Often it's automatic, not always, but it lets the owner know when an item is low in inventory and needs to be reordered. So inventory valuation can be done in different ways. The inventory on hand at the end of an accounting period is the ending inventory. And why do you need the value? Well, the value is needed when you purchase insurance or when you have to compute the worth of your business. For example, at the end of an accounting period, when you're preparing the financial statements and you have to assign a value to your ending inventory. You also need to calculate cost of goods sold, which is the value of the inventory you sold during the accounting period. This value is used to calculate the amount of income your business generated during the period. So there's different methods of calculating inventory value. You choose one method and then you use it consistently, but you can choose whatever method best fits your business. The most common inventory valuation methods are the average cost valuation method, the Fifo valuation method, which is first in and first out, or the Lifo valuation method, which is last in, first out. So the average cost valuation method, it basically averages the cost of the incoming items, because the cost of incoming items often varies over time when you are calculating your inventory. So the formula for averaging the cost is as follows. Your inventory value is equal to the average cost per unit times the number of units sold. So let's take a look at that. For example, wholesale paint supply is valuing its inventory of masking tape. On February 28th, the last day of the month, wholesale paint supply had 88 rolls of masking tape on hand. What is the value of the ending inventory for February? Well, let's look at it based on an average cost valuation method. The first thing you do is you find the average cost per unit, which you total the number of units that you have received for the month, and it was 240 units received. And then you see how this has multiplied out for total cost. On each time they received an inventory shipment, you see it was recorded at a different price. Well, what we are doing is we are taking the total cost and totaling it up, which was $542. And we are going to divide the total cost of the units, which is $542, by the number of the units received for the month, which was 240, and the average cost per unit is $2.26. So then we'll find the inventory value based on the average cost per unit. we will take $2.26 and multiply it by the number of rolls of tape on hand. This is the ending inventory, and it results in an inventory value of $198.88. And you do that again by totaling the units received, totaling the total cost of the units for the month, dividing the total cost by the number received to get an average cost per unit, and then multiplying that average cost by your ending inventory to get an ending inventory value. And that is average cost valuation. The next one is Fifo inventory valuation. So many businesses use Fifo, or first in, first out, to value their inventory. In other words, the first item purchased is the first item sold, and the most recently purchased items are the ones that are still in inventory. An example of this would be milk sold at supermarkets. The oldest items are at the front of the shelves, and the newer items are stocked in the back. And you would sell the older milk first because it's perishable, and you would want to sell the first ones you received before you sold the newer ones. And an example of how to calculate this, going back to wholesale paint supply, this time we're going to use the Fifo method to find the cost of the value of the 88 units in ending inventory. So the first thing we're going to do is we're going to find out how many were sold. And remember, we're doing first in, first out. So if we purchase 240 units from example 1, from the average cost example, and we have 88 left, we sold 152 units. So now we have to assign a value to the units sold. With Fifo, the 152 units sold are assumed to be the earliest ones. So then we look at our inventory record for the masking tape, and we calculate that we have sold 152 rolls, and we start at the beginning and go down until we have reached 152. Now notice that here on February 15th, you haven't sold all of them. You have sold part of them, and you still have some in inventory. So you have only sold 32 out of the units received for February 15th. But your total cost for sales were $335.60. So of the 80 units received, of course, you know, the other 48 are remaining in inventory. So here is the total cost of the cost of goods sold for Fifo, because you're taking the first units sold. And now we're going to find the value of the 88 units in inventory. So we go back and we say 48 of the units that we purchased on February 15th at $2.30 are still in inventory, as well as all of the ones that we purchased on February 22nd at $2.40. So adding these costs together, our ending inventory is $206.40, because we sold the first items, and then the last items that we purchased are still in inventory, because this is first in, first out. Now the last valuation method is called Lifo, and it is last in, first out. Some business methods use this, and this is the last inventory purchased is sold first. And for example, the physical flow of sand and gravel is an example of Lifo. When a new purchase is received, it's placed on top of the existing inventory, so you are using what you received last first. And here is the way to calculate that inventory. Of course, we still have our 88 units of masking tape in ending inventory, so we're going to figure out the number of units sold. Now remember, we're using the last ones first, so we flip-flop from Fifo. And we still have sold 152 units, but this time we're selling the last ones we purchased first. So if you start on February 22nd and you work backwards, you purchased 40 units on the 22nd, 80 units on the 15th, and then we're using our 32 units from February 8th because we're going to have 8 units that are remaining in inventory from February 8th. So, and then you see that we have got the total cost like before. We're just using the older ones first, or the ones we purchased last first. And our cost of goods sold now is $352 because we used Lifo. Now we are going to find the 88 units, the value for the 88 units in ending inventory. We start back at the last, this is back from the first of the month, we have 80 units, and then we have 8 units from February 8th left that will make up our 88 units in inventory. And if you go back and take the unit cost for each of these, multiply it out and add them up, our ending inventory is worth $190. And again, you can choose any of these as long as you are consistent on your application of the valuation. Depending on your business, sometimes, for example, the sand and gravel is a good example. You would be forced to use the Lifo inventory valuation, or if you had perishable items, such as perhaps produce or milk, you would want to use the Fifo method.